This podcast is intended for investment professionals only. All investing involves risk.
Welcome to this U.S.-based edition of L&G Talks. Today we're joined by Jason Shoup, our U.S. CIO, Jason Becker, head of U.S. credit strategy, Anthony Woodside, head of multi-sector fixed income and investment strategy here in the U.S., and Dan Dreher, solutions strategist. They've joined us to unpack our new U.S. Q2 investment outlook, including how AI disruption is reshaping the opportunity set and where we see the most compelling ideas across rates, credit, and equities. Let's begin with a question for our CIO. Jason, markets keep snapping back to geopolitics, but you argue the bigger, longer-lasting story is the AI disruption theme. Why is that?
Obviously, geopolitics still matters quite a bit. You've seen huge swings in oil prices, rates, EM currencies. But I also would argue that markets are really good at digesting geopolitical risk and then sort of become mean reverting once the range of outcomes starts to narrow. Unless it really persists long enough to become a true demand shock, it tends to be that geopolitics have a habit of being more episodic. AI, on the other hand, I think is not just a sort of episodic event, as we all are coming to appreciate. It's a multi-year change in how businesses really operate and more akin to kind of like a regime change. This year, we seem to be transitioning, maybe not so smoothly, from AI as CapEx story into AI as more competitive pressure within industries, where companies might use it to cut costs, speed up product cycles, take market share. And I think, and we haven't seen this yet, but I think likely use it as a motivator for M&A down the line. That's why we think it's more enduring and potentially more widespread, deeper, and potentially more risk or abrupt risk than markets are pricing. Our CEO here made an interesting point the other day too, just that it seems like other CEOs were much happier to talk about AI or were talking about AI last year. This year, it's gone relatively quiet. And that's not because I think AI has fallen down in the importance. I think it is all companies are turning quite rapidly to how do they actually deploy and start to utilize AI. And that's been taking up a lot of time, both with us and with others. So I guess when the baton, if you will, really passes from these enablers, the hyperscalers, to the deployers, is when we expect to see productivity start to show up. And that's a transition that we think will reshape profits. We think it will reshape the labor market, inflation, and maybe even the path of rates. So for the investors listening, I guess the punchline is geopolitical shocks can move markets short term, but AI is changing the earnings and the credit landscape over multiple years. And that's a harder risk to price than a war in the Middle East. Also, the last thing I would say is I'd be on the lookout for ways that AI could interact with geopolitics. We often think of them as separate themes in the market, but higher energy prices could easily cause some disruption to CapEx plans. Or if we were to get a large growth scare on the back of oil prices being as elevated as they are, you could see maybe the deployment of AI accelerate as companies look to increase their margins and deal with any sort of turbulence in markets for their products.
Thanks, Jason. What would you say is the clearest sign investors are still underpricing these risks that you've mentioned?
Maybe the easy answer is to just look at where credit spreads are right now, particularly investment-grade credit spreads in the U.S., but even worldwide. They're much, much closer or just shy of multi-year, multi-decade lows or tights. And that's sort of strange because we think the increase in, I don't know what you call it, maybe creative destruction on the back of AI in the economy will lead to more winners and losers in the economy. And for credit, that credit seems uniquely susceptible to that sort of backdrop, given that you tend to experience the downside pain of having a loser, but your upside gains are capped by the nature of the asymmetry of the product. Maybe away from that initial point, I'd also say it's been pretty interesting this year how investors have priced risk in general over the last 4 months with the war starting in March. Beginning of the year, we entered with a lot of supply concerns around hyperscaler risk dominating sort of credit markets and how we were thinking about value in credit markets. But that really faded as a few of the major hyperscalers seemed to be dialing back their guidance on how much they were going to issue. And then we moved quite quickly in February, and I think surprisingly, into this AI disruption concern emerging. And that's where concerns around software started to percolate, particularly software as a service, insurance, and then eventually private credit. And that seemed to me to be on the back of the model improvements and improvements in the harnesses that really came to fruition at the end of the previous year. It took the market a few months to kind of realize that there had been a capability step change. So credit had started to widen, sell off, kind of by late February against this backdrop of lower risk-free yields, lower treasury yields, which I think could be explained by concerns around AI disruption and the risk it might have to the labor market or to the broader economy. And then the war started. And what happened on the back of the war? Certainly the obvious, which is that oil increased dramatically and then rates moved higher too. They didn't really exhibit much flight to quality or much hedging value. They moved significantly higher as well. And what did that do? It created this kind of artificial demand for safe yield and really increased the demand for a lot of credit in a higher yielding backdrop. And amazingly, the result of that was, despite the war going on through much of March and into April and still sort of dragging on, many credit markets like USIG and US high yield ended up trading with spreads, are now trading with spreads that are actually lower than where they were before the war began. Against all that geopolitical volatility, I think behind the scenes, while the war has been going on in the last few months, we seem to have actually moved back to a AI supply story again. And I think there are two reasons why that's happened. One, we seem to be showing signs of compute being in a position of shortage. And really, that's leading to potentially more CapEx and higher CapEx forecasts from the major hyperscalers, which is increasing the need for bond financing to fund that CapEx. And then the second reason I think that we've pivoted back to this, how much supply could the credit markets need to underwrite, is that the speed of disruption, which was the theme that really dominated in February, has lessened. While I think the industry, ourselves, others, are collectively in this kind of period of figuring out the implementation frameworks, the harnesses that they can wrap around LLMs in a workplace environment, that's gone a little bit more at a measured pace than maybe we thought might be the case at the beginning of the year. So obviously really hard to predict when the next twist or turn may be, but we're guessing that AI disruption concerns will reappear. They'll broaden soon as the market figures out how to implement more efficiently, either because there'll be more advancements in these harnesses that we're starting to utilize, or because the next generation of models will be another capability jump.
Thanks, Jason. Turning now to Jason Becker. You note in the outlook that higher dispersion has historically aligned with wider aggregate spreads. What would have to happen for that issue level differentiation to turn into a broader spread move? And where do you think markets are most complacent today?
Yes, we've seen time and time again that dispersion turns into wider spreads when rating pressure becomes concentrated rather than unfolding gradually. Dispersion's typically fine until it triggers downgrades or defaults. Particularly within IG markets, you have fallen angels that can create non-economic forced sellers with IG mandates, benchmarks, or with insurance balance sheets. When that selling tends to hit in clusters, not in one-offs, that leads for marginal buyers to step back. So buyers that use ETFs or mutual funds, crossover flows, they tend to buy credit more broadly, not on a name-by-name basis. They're often comfortable when dispersion stays isolated, but when forced selling starts to show up and liquidity thins, they too will take a step back, and that's what causes index spreads to move wider. To your second question, I think the main complacency today, as Jason Shoup just alluded to, is in the second order AI exposure in investment grade markets. There seems to be an implicit assumption priced in right now that the disruption is slow and will remain orderly, although we believe there's a big risk for faster and deeper adoption that leads to disruption. The reality is that rating agencies lag, and often they have to play catch up. Historically, clustered downgrades, especially during periods of ample new issuance supply like we've seen to start this year, is when dispersion turns into an index level problem.
Thank you, Jason. Let's turn now to where we see opportunities in fixed income. Anthony, last quarter yields rose across developed markets as investors price a less accommodative central bank reaction function. What's your base case outlook for rates and spreads over the next quarter?
Your question is certainly top of mind for fixed income investors, so let's break it down. As Jason Shoup alluded to, yields broke out of the 6-month range to the downside in February as AI disruption fears and concerns around private credit continued to mount. However, as you rightly pointed out, yields have risen aggressively since then across G10 markets as markets shifted its focus to the outbreak of violence in the Middle East and the associated disruption of energy supplies. We believe a shift to a higher rate regime is an exciting opportunity for fixed income investors because it gives more opportunity to earn durable yield. However, given elevated uncertainty, security selection will be critical here. In rates, we believe valuations have cheapened sufficiently to warrant a neutral to long bias when it comes to duration, as yields are coalescing around what we perceive to be the higher end of the range. So if you look at the 10-year right now, we're trading at roughly 4.4%, and the 30-year is around 5%, a level that the market has struggled to go meaningfully above in recent years. If we move to corporate credit, we advocate for a more cautious approach here for a lot of the reasons that Jason Shoup enumerated, but particularly given expensive starting valuations and risk to the outlook. Now, there are a lot of positives around credit. Earnings have been very strong, and the rise in yields that we discuss solidifies the supportive all-in yield technical backdrop, which has been a dominant force for the better part of the last 3 years. Conversely, while the demand technical for credit remains strong, the elephant in the room, and we've continued to say this, is AI CapEx boom and the resultant deluge of supply. Considering the aggressive rally in credit last month and with spreads now back at start of year levels, we believe it is prudent to be a little bit more defensive here, and that's the way we're positioning portfolios currently.
Thanks, Anthony. You've said in the outlook that the front end of the U.S. curve looks attractive, and you see little chance of the Fed pivoting to a hiking bias. What's the best way to express that view today? And what's the key risk that would make you change your view?
That's right. We believe the front end of the yield curve is attractive, and we've started building a position in 2-year treasuries. For context, the 2-year is now trading more than 20 basis points higher in yield relative to Fed funds, after trading significantly below Fed funds for the better part of the last few years, including as recently as 2 months ago. So I guess the critical question is what's changed? Essentially, it comes back to the conflict in the Middle East, as the market has since priced out additional rate cuts from the Fed since the war broke out. To your question around risk-reward, the attractiveness of the trade hinges on a few key questions here. First, have the developments over the last 2 months significantly increased the odds that the Fed is done cutting? We would concede that this has become a more credible debate. So just last month, Chair Powell acknowledged that the center of the committee is moving toward more neutral language in their statement. However, there is a second question that is also critical to this debate, and that is whether a pivot to a hiking bias is a material risk. The argument for hikes rests on a few pillars. The first one is the duration and the magnitude of disruption from war would lean to more hawkish monetary policy. Secondly, when you look at U.S. economic data, it's been relatively solid, supporting the broad-based view that the U.S. is more resilient than other developed markets to shocks and that the economy can handle higher rates. Third, other developed market central banks have pivoted to an outright hawkish bias. However, there are significant differences between the Fed and its developed market peers. One, most developed market central banks have a single mandate of price stability. The Fed is governed by a dual mandate. Price stability is one, but max employment is the other. Secondly, the administration has been very vocal and has applied a lot of pressure for rates to move lower. We do think that the new chair, Kevin Warsh, is likely going to be under considerable pressure to deliver just that. Finally, we go back to what we always use as our North Star, and that's valuations. The market has significantly repriced and is now assigning a greater than 50% probability of a hike by March of next year. So this shift not only assumes higher for longer oil, but it also assumes limited headwinds to the U.S. economy in terms of labor market weakness and/or a sharp slowdown in growth. We feel comfortable taking the other side of the trade, given how much valuations have moved.
Thanks so much, Anthony. Let's turn back to Jason Becker. You write that we're cautious on IG overall, but more willing to add risk via the primary market due to concessions. What does an attractive new issue look like in this environment?
New issues are always the cleanest entry point to add risk, given that you don't incur any transaction costs. But in a tight spread range like we've seen recently, even 5 basis points materially improves the entry point. Meta is a good recent example, came with roughly a 10 basis point concession, effectively pricing at the year-to-date wides. What's reinforced this dynamic recently is how hard deal timing has become for issuers and for syndicate desks. In normal times, many of the risks the market deals with are scheduled, whether that be a Fed meeting or economic data releases, which provides dealers and issuers optionality for a go, no-go, whether or not they want to bring a deal. In contrast, the past few months has been much more headline-driven and unpredictable. There's also been negative weekend headlines, which has shut Monday down from new issuance, whereas Monday had been the most popular day for deals. The uncertainty has forced higher concessions, but it's also clustered the deals onto fewer days in the week, which is leading to some market indigestion. And from our standpoint, that backdrop makes primary even more attractive, especially when we could stick to high-quality companies raising capital for future growth, either via M&A or CapEx. If you can buy a AA credit at the wides of the year without paying a transaction cost, that's exactly how we would want to add risk right now.
Thank you, Jason. We'd be remiss if we didn't turn our attention to private credit. Dan, you write that we see opportunities in infrastructure private placements tied to digital infrastructure, renewables, and grid investment. What specific AI boom infrastructure exposures look most compelling today? And what would be your red flags that the theme is getting overcrowded or mispriced?
The most interesting part, in my opinion, of the AI dispersion trade that Jason mentioned is the opportunity set itself. Issuers are tapping the full fixed income market. While any one deal may screen as strong relative value in its own pillar, we've seen an enormous benefit to having full private and public underwriting skill sets all under one roof. And that's really unlocked a more holistic relative value view across capital markets. The most immediate benefit we've seen is deeper issuer and sector understanding. On the public IG side, analysts bring deep knowledge of large issuers. So think about all the hyperscalers that have been in the IG market for a very long time. That's allowed us to enhance our private underwriting, really understanding how those hyperscalers work. And then on the private side, our infrastructure teams bring a lot of structural and ratings experience back to public markets. This repeated exposure across markets with similar issuers and whatnot, it ultimately builds institutional memory, shortens underwriting cycles, and can really improve confidence in investment decisions. So this combination allows for faster and more conviction at the time of execution. This has really allowed us to optimize exposures and have a clearer view of relative value across the asset classes. If you think about a side-by-side assessment of public and private structures, we can really isolate where you're getting compensated for risk. This allows us multiple lenses on issuer or sector exposures, which ultimately helps us surface trade-offs that others may miss. In the context of this discussion, infrastructure, utilities, energy, that's really where we've seen the most overlap. But benefits of our platform structure extend to a variety of other sectors. You asked about red flags, and I'd argue that our structure actually gives us a great vantage point for identifying headwinds early. We think about the AI infrastructure build out at a high level requiring 5 different things: power, land, labor, materials, capital. The first 4 requirements act as a natural constraint. That 5th requirement, capital, is currently not a constraint. The build-out's been, or the capital spend has been gigantic, but aggregate spending can certainly weigh on pricing in capital markets. So I think of this as a demand game. Demand for compute continues or accelerates. You could see the capital outpacing those physical constraints, which would result in cost inflation that cuts into expected margins and extends the timeline to project completion, further cutting into margins. If demand decelerates and the capital arrives too early, you're going to see underutilized capacity, compressed margins, and really a more painful repricing and refinancing for capital market investors and existing bondholders.
Thanks, Dan. We've covered lots of opportunities across fixed income, both public and private, but let's turn to equities. Where do we see opportunities in equities today?
Absolutely. So to align the broader conversation we're having here, the fixed income market offers some level of knowable and contractual cash flows. Bondholders don't really care who ultimately wins the AI race, but rather they only care that they're paid back in the way that they expect it. But on the equity side, investment outcomes are more driven by that marginal upside. So growth beyond expectations, pricing the ultimate residual value, and ultimately company pricing power. In the listed infrastructure equities, we focus on companies operating in segments with a regulatory edge or monopoly-like characteristics. Those are companies that have high barriers to entry, they provide proven essential services, and they also exist in a place where there's low customer bargaining power. These businesses are those that are not meaningfully sensitive to competition. They're not meaningfully sensitive to technology cycles or commodity prices. Basically, where cash flows tend to be durable and inflation linked. That framework ultimately explains why you don't see heavy direct data center exposure in our listed infrastructure portfolios. Data centers may be essential to the AI buildout, but from an equity perspective, they sit in very competitive markets with significant capital intensity, tenant concentration, and technology obsolescence risk. In the buildout, we'd expect much of the economic upside to more accrue to the hyperscalers and not necessarily to the direct infrastructure owners. So instead, where do we see equity opportunities related to AI? It's really one step upstream and downstream. So regulated utilities, electric transmission and distribution, grid investment, and then other essential networks that benefit from rising demand, but retain pricing frameworks, retain regulatory visibility, and maintain long asset lives. So the through line through all of this is, in credit, we like AI infrastructure because we can be paid for the certainty of the build out. While in equities, we more focus on businesses where that demand translates into durable earnings power.
Thanks, Dan, and thank you all for joining us. For more on our investment team's views, be sure to check out our Q2 U.S. Investment Outlook.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of L&G's Asset Management Division, as at the date of publication. This podcast is for informational purposes only, and we're not soliciting any action based on it. The information discusses general market, economic, or political issues, or industry or sector trends. It does not constitute research or investment, legal, or tax advice. It is not recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against L&G in relation to the accuracy or completeness of the information contained in this podcast. Where this podcast contains third-party information, the accuracy or completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person in any jurisdiction where such distribution would be contrary to local law or regulations. Copyright 2025. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. Unless otherwise stated, references herein to L&G, we, and us are meant to capture the global conglomerate that includes, in the European Economic Area, LG Managers Europe Limited, authorised and regulated by the Central Bank of Ireland as a UCITS management company pursuant to European Communities Undertaking for Collective Investment in Transferable Securities Regulations 2011 as amended, and as an alternative investment fund manager pursuant to the European Union Alternative Investment Fund Managers Regulations 2013 as amended. In the USA, Legal and General Investment Management America, Inc., a US SEC regulated investment advisor. In Japan, Legal and General Investment Management Japan KK, a Japan FSA registered investment management company. In Hong Kong, issued by Legal and General Investment Management Asia Limited, which is licensed by the Securities and Futures Commission. And in Singapore, issued by LGIM Singapore Pte Limited, company registration number 2022318776W, which is regulated by the Monetary Authority of Singapore. For full terms and conditions, please please visit our website. To find more content, you can check us out on LinkedIn or on our website.